Hello and welcome to the podcast hosted by myself, Louis Kessinger, and my dad, Tommy. We are a part of the Kessinger Lee Group at Baird and have been serving investors in our area for 4 generations. Our goal is to start a conversation around topics within the world of finance and to educate you, our listeners. All right, welcome back to another episode of Father-Son Finance.
Howdy.
Today we're going to be talking about the difference between a stock and a brand of a company. We're going to be talking about how maybe sometimes, even though you know and love a brand, it may not necessarily mean that it is a great stock to own. So there was actually, I'm going to pat ourselves on the back here because we were already planning on doing an episode on this topic. And then the fine folks over at Barron's published an article on this topic. So I'll kind of let you open up with that.
Yeah, well, so we hear things all the time about, is this a good stock to own because I know the brand well. And one of the famed investors of all time, Peter Lynch, who used to run the Magellan Fund at Fidelity, used to say things like, well, invest in what you know. Yeah. There were several books. One of them was called One Up on Wall Street that talked about this concept of invest in what you know. And that translated for most people to brands that they bought frequently.
Yeah.
Right? Like the services that they use, what have you. But what this study from Barron's took into account over a multi-decade time frame was that actually the returns of those two things are not the same. They're not equal. So just investing in what you know may not be the best investments for your portfolio.
Yeah, and I think it's easy to get on the line of logic of, well, everyone I know buys Nike shoes. Everyone I know has Verizon phone service or AT&T phone service.
Right.
So, sure, yeah, they're probably profitable. Their stock will probably go up. Nobody's going to stop using Verizon or AT&T. And so you get in that logic and it's like, yeah, sure, this seems like a great investment. And it's just not always the truth.
Not always the case. And so there is some, we need to talk about what is a brand. A brand is something that has been developed over time through marketing, through a good experience that you might have in using a product or a service. Coca-Cola is one of the best known brands in the entire world. Well, Why is that? Because they have marketed themselves all over the entire world. So let's take brand in this case as a quality factor. And again, from this Barron's article, if you look at the rankings of global brands from 2000 to 2017, those companies with the strongest brands returned an average of 5.9% per year versus 12% for stocks, 12% per year for stocks with the lowest brand ratings. And so that study found similar results depending upon whether you did that on an equal weighted basis or a cap weighted basis, which I don't mean to get too nerdy on that. But all I'm saying is over a multi-decade time frame, investing only in what you know because you use the service or your buddy has it or quote everybody you know has it is not the best reason to invest.
Right.
Well, the article goes on to talk about that brands come and go. Right. So in year 2000, the top ranked brand in the world, according to this study, was Coca-Cola, and by 2017 that had been supplanted, overtaken by Apple. And then other companies like IBM and Nokia, which were in that top 10, top 5 in year 2000, were now overtaken by Alphabet and Amazon.
Yeah.
So, this has to do with the business cycle, which I think you're going to talk about.
Yeah, and so on that point, so the business cycle, the life cycle of an individual business starts out with what is called the introduction stage, and that's when a business first starts and they're first selling products, they're trying to get their name out there. You know, that may look like door to door or local advertisements, things like that. And then you get to the growth stage, which is going to be the company's now started to make a little bit of money. They're selling products, they have customers, but they're trying to broaden their base. And so you might see commercials for this company. You might see this company sponsoring sporting events, things like that. And then you get into the maturity stage, which is to talk about some brands that may be in the maturity stage right now would be like an Apple. They're not selling a ton more iPhones every year.
But they have a ton of them out there.
But they're like, quote unquote, everybody owns an iPhone.
Right.
And so you kind of like, they're not growing their profit, but they're making more money because all of these customers are now kind of locked in to their customer base. And that's the maturity phase of the business cycle, where you've kind of grown to not your maximum amount, but there's not a lot of market share left to gain.
Or you've got to innovate.
Right.
You've got to re-enter that business cycle. And Apple, as an example, created the iPad. It did not exist, and it was a whole new growth phase for them.
Yeah.
But again, this isn't about Apple.
Yeah.
It's just
but
about
so
products.
To your point, after the maturity stage, you then can go one of two ways. You either decline, and somebody else comes along and innovates and makes something that makes your product now irrelevant, or you innovate and you restart the business cycle and you try and get your product back out there, and then you grow. And so all that to say, that is the business cycle. And two companies that I kind of like to compare in a modern sense is Nike and OnCloud. So Nike, the Nike check mark has been one of the most recognizable brand logos across the world. And you see soccer players have it, and that's the most global sport there is. I mean, it's everywhere. And then you see OnCloud, which, to their credit, they've done a great job. They are currently in the growth stage. A lot of people may have OnClouds, but all of those people probably have a pair of Nikes too. Right? And so that to say, you look at these two brands, I'll call it, and Nike year to date has just not done well at all. In fact, on an annual basis, Nike is actually down almost 12%, 11.8% as we sit here on June 7th. But then you go and look at OnCloud, the newer and more hip, hot company, but not the coveted brand that Nike is. They're up 56%.
Right. So, that OnCloud, brand loyalty, their brand recognition is rising.
Yeah.
This leads to another piece of this, which is, even if you love a company and you love its products, that information alone doesn't tell you enough about the stock as to whether or not you should buy it. There may be other competitive dynamics going on, macroeconomic factors, but this goes back to what we talked about at another podcast, is the price and the value.
Yeah.
So don't get cooked in with that. And then the other thing is that while you may be familiar with a brand, that should be a starting point.
Yeah.
It should not be the one thing you do to make an investment decision.
Yeah.
And so just, a couple of things to keep in mind is like, you are not alone out there in the investing world. There are other markets are made up of millions of people making decisions every day. And so, the stock may have a great brand name, but it may not be the best investment, especially for you.
Yeah, and just to hammer it home a little bit more, I think the point that we're trying to make is that a lot of times the biggest brands have the most money because they have sold the most products. And guess what? That means that they are in the maturity phase of the business cycle, which leaves them to do one of two things: decline or restart the business cycle and innovate. So by definition, because they're in the maturity phase, it would actually make sense that a brand that is not as well known has more room to grow, because not as many people have heard of them. And as more people find out about that company, then that brand grows, and then they reach the maturity phase eventually. But I think it's counterintuitive at first glance to think that big brands would, according to this study, be not as great of a stock. When you take a deeper dive, though, it makes sense that smaller companies have more room to run.
Yeah, and oftentimes the emerging companies in these various sectors, you mentioned shoes, but it could be anything. It could be cell phones, it could be computers, it could literally be anything. But those emerging companies have products that are literally changing how we work, how we live, how we play, how we interact, what have you. And so this is not to say that you shouldn't invest in companies with well-known brands.
Right.
We're saying that's a starting point and to be cognizant of it. Some of the biggest mistakes I've seen are people who actually invested in a brand very early and made a lot of money. Take an AOL. And AOL was a small dial-up internet type company that came out of nowhere. They literally used to send discs to your house so that you could dial in using your phone to chat with people over this thing called the internet. And the stock went through the roof, and then it plateaued. And so you just, what you can't do is buy just on the name and then expect it to work forever. So those people who have owned AT&T for decades have gone through multiple changes in the actual investment that they own. And while AT&T may be a great brand that literally sponsors every sporting event on the planet, their wealth creation has been next to zero since the breakup in 1984.
And I think that goes to
all U.S. automakers too.
I think that also goes to the management of a company. And so you may have a company like we've been talking about with a great brand, but looking a layer deeper and looking at the management of the company, because a company like AOL didn't reinvent themselves and didn't
sold themselves,
re-innovate like an Apple has, because Apple has done it time and time and time again. They had the Macintosh, which was amazing, and then they had the iPhone, which was revolutionary, and then they had the iPad, which was fantastic, and so they've done it time and time again. And so just because the brand is great and they're in the maturity phase, look at the management and then decide, do I think they can reinvent themselves?
Look at the market.
Because eventually everybody has to reinvent themselves. Every company does.
Yes. Adapt or die.
Yeah.
Adapt or die. And so clearly this is not a commercial for any of these companies. It's definitely not a commercial for Apple. It's the one that's the most ubiquitous and the easiest for us to, because we all use it every day.
I'm staring at an Apple phone right now.
Right. But what we just want for you, the public, to think through why you're investing in something, what the next step should be.
Yeah.
If you recognize something, that should be your leaping off point before you commit capital. That's the sort of warning and lesson that we want to provide to you from these great research groups out of Barron's.
Yeah. Create a process and stick to that process.
Agree.
Yep. Hey, thanks for listening.
Thank you.
We hope you learned something, and let us know what your favorite brand is. During this podcast, the following individual stocks were mentioned and discussed: Nike, symbol NKE; Verizon, symbol VZ; AT&T, symbol T; Coca-Cola, symbol COKE; Apple, symbol AAPL; IBM, symbol IBM; Nokia, symbol NOK; Alphabet, symbol GOOG; Amazon, symbol AMZN; OnCloud, symbol ONON; AOL, symbol AOL. Please note that Robert W. Baird Incorporated and Company makes a market in the securities of these companies discussed in this podcast.
This podcast is intended for informational and educational purposes only. It is not an offer to buy or sell, or solicitation of an offer to buy or sell any security or investment, or to participate in any particular trading or investment strategy. The information is considered to be from reliable sources, but its accuracy is not guaranteed. We do not offer legal or tax advice, so please consult your tax or legal professional for information specific to your situation. The opinions expressed are those of the speaker and not necessarily those of Robert W. Baird & Company Incorporated. Please note past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. You should carefully consider investment objectives and risks of any investment before investing. An investment cannot be made directly in an index. Securities and investment advisory services are offered by Robert W. Baird & Company Incorporated, a registered broker-dealer and investment advisor, member NYSE, FINRA, and SIPC. You should consider the investment objectives, risks, charges, and expenses of each money market fund carefully before investing. This and other information is found in the applicable prospectus for the money market fund. Contact your Baird financial advisor for a prospectus. Please read the prospectus carefully before investing. Money market funds are managed to maintain a stable $1 share price. An investment in a money market fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although the fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund.